So today on the show, we're going to talk about going head to head with bigger companies. When you're first starting out new, it's very hard to compete with large companies. Even me, where we are today, I'm competing with companies on most properties that are probably 10 times our size. And it's very easy to look at that as a big disadvantage. Today, we're going to talk about some of the advantages that it gives you. One of the big advantages is when you're dealing with a big company, a REIT or something like that, they're generally going to have a whole board that has to make decisions for them. So they're very slow moving compared to an individual. So when I go and look at a property, I can make the decision right then and we can move very quickly. We don't have to go through a whole process. It can be just an individual making that decision. A company that's really big, really bloated, it's going to take them a long time to make that decision. So speed is definitely one thing that's on the side of the smaller investor. There's also the criteria. So you can change it as the market changes. A lot of these funds or REITs will have a very strict mandate on what they can buy, what amount of leverage they can use. And you can change that. If it's you buying the building, you can decide, maybe I'm going to leverage higher on this property because I really like the area, or I'm going to get creative, going to see if I can do a VTB. Things like that that a big company can't do can allow you to buy properties that are really good, but that can't be financed the way that a bigger company would want to do it. So it really depends on the seller. If you know they're in a position where they need to sell by a certain date, maybe they're buying another property or they want to get it done by the end of the year, and you know that you can come in and close really quickly, opposed to a bigger company, that can be something that gives you an advantage. You can probably get a little bit of a better price that way. There's other things too, like the type of buildings you pick. Even in my market, it's very hard for me to compete with anything that's concrete built or built, after the 2010s, that's at scale, because institutions, that's what they want right now. So they're basically paying any price to get it. I can't compete with that. So I'm looking at, older, not too heavy value add, but wood frame walk up. And that's a space I really like. That's a space that not a lot of the people in our market right now are buying. So it's a nice little niche. We can go in there and buy, a 100-unit 4-story building, and I don't have people coming in and overbidding on it at an institutional level. Whereas if I go and look at a tower that's concrete built, that's going to be the case where the cap rates are going to start coming down. They're going to be very aggressive to get that property because that's what they want right now. We also know that they're going to be selling this older wood frame walk-up. It's kind of a general evolution. You start with that stuff and you transition into the newer built concrete stuff as you get more scale because you just want to hold it for forever. And that gives, newer investors or smaller investors the opportunity to pick up some of that product. You can also look at areas. Most big institutions or REITs will have a mandate where they're only buying in core areas, big cities. So if you can buy right outside of the city, Edmonton has a lot of bedroom communities. Sometimes those big REITs have a mandate where they can't buy in let's say Sherwood Park or Spruce Grove. These are local to Edmonton. They're little neighborhoods right outside of the city. So if you can buy those areas, that gives you a nice edge where it's basically inside the city, but it's not technically, it might not be in their mandate. So that gives you an edge where you can buy property that are still in really good areas. At some point, they're going to be absorbed by the city anyway. I look at areas sometimes, somewhere like Leduc that's not technically part of Edmonton. And I think if I buy a bunch of institutional quality assets there, if it ever gets annexed by the city and becomes part of Edmonton, there will be that market be able to sell it back to those institutions on the back end. Another place where I think smaller investors, if you want to put in the work, can have a big advantage is on the management side. As you get scale, if you have 10,000 units, it's very hard to give a good quality of management in a portfolio that's spread out. So a lot of these companies you'll see don't have a great reputation on the property management side. If you're smaller, you can spend a lot of time taking care of the property, making sure that that's where you have an edge. So in our company, we spend a ton of time on the property management side. We get all our systems in place. You want to make sure the tenants, we have a good brand that they want to stay with. And that gives us an edge. When we go into a property, we're pretty certain that we can get turnover down, we can get vacancy down, and just we can provide operational efficiency, and that can add a lot of value to the property over time. It's harder to do that when you have a huge amount of scale. Depending on the company, some of the big companies do it really well, but it's usually not a huge priority for them. Their strategy is based around the investment, not so much the managing of the assets. So if you put a lot of priority on that, I think it can give a smaller investor a big edge. And the reality is when you're starting out, you're probably looking at, maybe a 20 unit or a 40 unit building. Usually there's not going to be institutions that are going after those properties. So you don't want to stay in that size of property forever either, but it gives you a nice foothold to get in where you're not competing. You're going to be competing with other individuals on those smaller properties. So I would say look at properties, even if it's bigger ones, that you're not competing with an institution right at the beginning, because they do have a cheaper cost of capital than you're going to have. They're going to have, the security of them being much larger than you. So there's that trust factor when they put something under contract versus you. But you do have a lot of advantages. Most REITs will have something in their structure where they can only leverage up to a certain amount. So in today's world where you can get, 5% money on a deal, you can only put 5% down. That can give you an advantage where maybe you can buy a property where if they have to put in 25%, it doesn't make sense for them, and you can come in and get the deal leveraging it higher. If you know what you're doing, if you're being secure and safe about it, that can definitely give you an advantage over a bigger company that has a mandate that they can only leverage up to a certain amount. Another advantage that a smaller investor can have is usually a REIT or bigger company. They'll have a certain return they have to offer. So you might see a property that you're looking at and you say, hey, maybe year one it's not going to perform, it's not going to give me much of a return, but I have the money to put into it and I can hold it over a long period of time. So that gives you the advantage to be able to go and buy that property, where a bigger company that has to offer a certain return to their investors can't go and buy. So there's lots of advantages. As a new investor, you always think it's a negative, but really you're starting out from zero. There's a lot less risk for you to go and buy something, because you're just going to go back to zero if it doesn't work out. Whereas a publicly traded company or something, there's a lot of like risk mitigation, things that they have to do to make sure that that deal works for them. So there's definitely advantages to being small. And the goal is always to become big and have all of the problems that the big companies have long term. The other thing is speed into the market. There's a saying, it's like institutions are the last ones to get into a market and the first ones to leave. In a market like Alberta, where the perception is that we're boom and bust, institutions are shyer to get into the market because they think it's just going to be a short-term thing. So you can get in before them. If there's a market where that's really hot and you think there's a lot of runway there, you can get in before the institutions get in. And generally they're going to be the first ones to go. They're going to pull out, or their mandate might say they can only have a certain amount in one area. So you can play that as well. If you're local to a market and you know that good things are coming, you can go in and buy up that market, and when they come in, you can sell to them, or you can just get your foot in the door before they get there. And they're usually going to be the first ones to leave when things start to turn. They're going to slow down their buying, and maybe it's just a very temporary downturn, and you have local insight on the market, and that you can continue to buy. So there's lots of advantages to being small, to knowing your local market. I like investing where you live because you have that local insight. You're going to get the information way before these big companies do, and have that advantage to be able to buy before they can get into the market. Also, on the relationship side of the business, it is a people business, right? So a broker will prefer to work with you if you're a good person, you're local, you've done a lot of deals in the area, over an institution which really they don't care as much about the people side of the business. They're just looking at the numbers. So I always think there's an edge there where, if you can build that relationship with the brokers in the local area versus a big company that's coming in and it's, 20 people down from the CEO that's talking to them, they're not going to probably treat them as well. They're just looking at it like a transaction. If you can make it a people business, treat people really well in the area, you're going to get to see deals before other companies do. You're going to get some preferable treatment. So I think that's a good angle too. Just make it about the people, treat the brokers really well. Don't try to act like a big deal and try to screw people out of deals or retrade a lot. If you can do that and get a reputation in the market, I think that goes a long ways and actually gives you an edge over like these bigger companies that are going to have very strict mandates. So it really doesn't matter about the people in the business. They just have to buy a deal that makes sense for their numbers, and they kind of take the people aspect out of it. So I think if you focus on the relationship, it can get rid of a lot of the negatives of being smaller and actually help you to get an advantage over these bigger companies. So in this episode, we talked about the benefits of being smaller in a market opposed to these big institutions. So you have things like speed, building relationships with people, being able to go in markets, using leverage differently. Those are all big advantages when you're starting out, and you need to look at them like an advantage, not like a negative. Thanks for listening. We'll see you guys next week.